We're here to talk about ESG investing yet again. We're going to try to make this conversation a bit different from what we've had before. Thank you very much for joining me today, Kalpana and Linus. Let's start with setting the tone on what ESG investing really is and how are you getting the buy-in of internal stakeholders to sort of go along with that wave. Kalpana, if we can start with you.
Sure. First of all, a very warm hello to all of you. It's wonderful to meet in person after a long time. So I love the question, why ESG? There are three reasons I'd like to touch upon quickly. The commercial, the regulatory, and impact. Three reasons why we must focus on ESG. First, ESG is a very commercially sound prospect. There's a lot of evidence now that shows that companies, entities which are leaders in ESG face a lower cost of capital, whether it is debt or equity financing. If you are a leader in ESG, chances are that you will face fewer regulatory fines and compliance issues of that nature. So again, financially it makes sense. On the market-facing side, chances are that you will have more market share, there'll be people wanting to buy your products, and so on and so forth. So essentially, both on the cost and revenue side, it makes sense for companies and entities to do ESG. Second, regulatory. A lot of regulators today are asking for disclosures, and you would need to disclose what you're doing in addition to your financial statements and so on, need to also disclose on ESG. And third, impact. A lot of investors, shareholders, bankers, general public, in this era of greenwashing, they're like, gone are the days when companies can raise money and gain market share by just promising to do great things. Now people are like, no, we need to know what are you doing with the money or with our business dollars, what is the impact? So for these three reasons, ESG, commercially sound, regulatorily sound, impact sound investment strategy.
Okay, Linus, for the man on the street and your clients generally, why is ESG important? How are you really bringing that into the conversation?
So I think ESG is sort of the word of the year at the moment, or the term of the year. But it's actually sort of a challenge because of all the different standards. It's a challenge because of all these terms going out there. Everyone now claims to be sustainable or ESG friendly in some shape or form. I mean, we've all gone for the conferences where we're all given tote bags that says, I'm green, right? And we have 15 of those at home, But I think it still hasn't gone down to the level of an investor where they go, how do I think about the companies I invest in? And one of the steps that we have been taking is to communicate some of this, right? So we're trying to make it as conventional, sort of a principle, as much as you say PE ratio. We want our investors to be able to understand the opportunities and risks for companies in the ESG space. So we've started publishing equity research reports that incorporate that as well. So besides telling an investor, this is how much the company has made, this is what the company is doing, you also have an appendix that says, this is what in an ESG framework and relevant to this business sector, this is what the company is doing, and you as an investor can make up your own mind. Our reach is mainly to individual investors, across Asia, and therefore we feel this is important because this is where the action is happening, right? We've heard a lot of speakers that says wealth is being generated here, but production is also happening here. A lot of the challenges are happening here, and that's why we think it's important to get that sort of support. A lot of it has been top down, but we also want to get some measure of support from the bottom up. That's what I think.
So conventional wisdom sort of says that Asia has always lagged the West in terms of disclosures and ESG awareness. Is that changing at all, especially with the pandemic, with the government push towards sustainability investment? So are you finding that disclosures are improving, and in which countries or which sectors are you seeing the disclosures really improve in Asia?
So there is a perception in the market that Asia is the sleepy backwaters of ESG, that the movement which started in Europe will eventually make its way to the United States, and eventually at some point will make its way into Asia. Now, reality is a little bit different. Two quick points. Over the last 20 odd years, Asia has seen a lot of growth, unprecedented growth, but at some very high environmental and social cost to its environment and its social fabric. Today, countries are changing that. So, for example, on the solar industry, China alone single-handedly made a huge investments in solar over the last 10 odd years. And today, Asia is the largest carbon sink in the world. That 55% of renewables capex between 2021 to 2025 is earmarked for Asia, and that is about $720 billion US. That's on the environmental side. On the social side, Asia connects very deep into the global supply chains. So we are the manufacturing hub of the world. So a lot of conversations which may start in European boardrooms, they have to, the ESG around supply chains, those initiatives are implemented in Asia. So the action is happening here, and there's a lot happening on the ground. And third is really the global consumer today is very aware. And you could have a consumer sitting in Norway or in India or the US that just simply says, well, I don't want to buy from this company because I see there is a child labor issue or some other supply chain controversy and so on. So there is a lot of action happening in Asia, and governments here are also requiring their regulated entities to disclose what they're doing.
I think, I'll echo some of those thoughts. Initially, if we had this conversation 10 years ago, most people would be comparing, saying, how do conventional investments do versus ESG investments? Right. I think that conversation is less of a conversation now. I think people are genuinely interested in the spectrum of green investments that are available out there. People are asking questions of, what is the impact that this has, right? The dark green side or the lighter green side, negative screens. But there's a conversation now happening. I think for the retail investors, not quite yet, but that's also because a lot of the financial institutions are still working out processes, still working out the data streams. In terms of the listed companies, we are getting there. It's beginning to happen. Right now, there's still a gap in terms of people, because all this has come very quickly. And to train up the people that are involved in the ESG side of things, and then to dovetail into a conventional approach, which is what I believe. I believe that ESG investing will be conventional. As much as we talk about positive cash flow and P ratios and things that are healthy, the ESG will capture the negative externalities that are not being captured right now. That's what I think will happen.
So when you're sort of poring over the sustainability reports of companies, are they left wanting, are they found wanting rather in any particular areas when it comes to disclosures? Are they disclosing more on the E side and less so on the S side or the G side? What do you find?
I think that there is a tremendous gap in the market on how to measure, what to measure. Very huge gap in understanding what sustainability issues to first focus on. So what issues are financially relevant for your company to focus on, and then figuring out which KPIs or metrics really capture that bit of information, and so on. So let me give you an example. So in the current environment of climate crisis, one metric that everybody uses and should use is emissions-related metrics, GHG emissions. You have companies making grandstanding claims of how we will reduce carbon footprint. Okay, what does that mean? What do you mean when you are reducing carbon footprint? Okay, we will report on GHG emissions. Okay, is it scope 1, scope 2, scope 3? Is it absolute emissions or emissions intensity? If it is emissions intensity, which type of emissions intensity? Are those metrics SBTi approved, which is Science-Based Targets Initiative? And you can imagine, there are a whole host of very scientifically relevant metrics-related questions which companies just, the industry, financial markets just doesn't have the bandwidth to process and report on. So we are at a stage where there is very limited understanding in the market, and the market will mature. I don't want to have a doomsday, a view on it, but just even, for example, on the climate metric alone and emissions metric alone, I've just said the relevant questions which people just don't know, and hopefully it'll change.
I mean, the bandwidth issue mentioned is very real, right? The average listed company now fills in 50, 60 surveys, one survey a week from different parties on their ESG track record, right? I think it's not so much the data, it's not the profusion of data, but rather what we look at, right? How do we take data and make it information, make it relevant, right? It has to be relevant to what the company is doing. It has to be relevant to what business activity the company is involved in. I've seen companies, and it's greenwashing in a sense, right? I've seen companies that are financial institutions tell me about how many air miles they're doing. It's irrelevant to me unless you were an airline company, right? Or a logistics company, or how much air conditioning you're using. I mean, honestly, those are vanity metrics, right? I think it's really important to look at what's relevant. So what's relevant is what business sector or what classification that company does, and then look at how we transit or improve on that, right? What was the relevant ESG sector that they're involved in? And there are also complex areas that simple metrics can't cover, right? I mean, at the moment, my colleagues and I, we're thinking hard about biodiversity, right? How do we sort of measure that? How do we grapple with that, right? You can't just take a satellite picture, and come out with a metric for that. So I think that there's some of the nitty-gritty that we're still still trying to work it out. It's not a simple solution, but I think over time, enough heads put together. And the good news is lots of us are thinking about it. Lots of different participants from different angles are thinking about it, right? The listcos are thinking about it. The regulators are thinking about it. The investors are thinking about it. And hopefully we'll find some sort of balance in that, discussion.
So what metrics do you really look at to detect greenwashing? We have a question from the audience as well. How do we detect greenwashing, and what are fund managers doing to curtail that? So what safeguards do you put in place to make sure you're not vulnerable to greenwashing claims, and how do you detect that when you invest?
So on our end, I think, first of all, we look at it from a company perspective. What does that company do, right? So it's our belief that the greenwashing is not so much in fudging the numbers per se. It's more of giving you irrelevant information or irrelevant data. Let's focus on what the company does, what the main business activity does, and what their ESG impact is, right? If they are a financial institution, let's say, then we should really think about what their governance is on their financial products, what their impact is on society when it comes to the selling of their financial solutions, right? As opposed to purely their carbon emissions. So in a sense, we're trying to adopt a more holistic picture of a company. And that's, over the long term, when we look at a company, it's just like understanding what a company does, right? You read the management reports, very fundamental sort of investing methodology.
Results, and more results. Data, and more data. So for example, we're a lender. We lend to companies who want to do ESG compliant trades. Great. So we say, okay, let us attach your deal or your company, this particular transaction, financial transaction, to the attainment of specific ESG metrics. So if we lend you $100, at the end of the day, what are we expecting to see in return? Given their industry, given their company at this point in time, and the strategy that they have, whatever the company is, we say, okay, this is where you are, this is your baseline, over the next 2 years, 3 years, 10 years, based on the financial product the DB is offering. Okay, so that is your runway, if you like, from a baseline of today for these 2 or 3 very carefully picked KPIs and very carefully designed metrics corresponding to those KPIs. From today's baseline, you will reach what by tomorrow, by day after. So very specific targets. So we know, the regulator knows, the public knows, you know, if there is a press release associated with it that the company is releasing, you know, that this is what we are doing. With this money, we are here, we hope to achieve that target. And it's all very clear. Our judgment and our commitments on specific metrics, essentially. It all has to be quantitative relevant.
I feel like in the ESG ecosystem, there are lots of potential spaces where you could find greenwashing, right? So you have Article 8 funds, for example, that have seen 30 billion in outflows in the past quarter because investors are like, just funds promoting sustainability, what does that really mean? Or you have the SEC looking at index providers and how they're sort of greenwashing their gauges, essentially. How are you really avoiding all those claims or avoiding putting your investors' money into these things that could potentially have greenwashing allegations against them?
Couple of things. I mean, first, I mean, you know, you have to, again, as we were saying, focus on specific results. Do not, and that's what we tell our clients all the time, that it's best not to try to have quick sound bites. Okay, there is one particular ratings agency which comes along and tells you that this ETF is rated as, or this company is rated as an A or a B or a C. It's much more complex than that. So it's much better to go right down to the transaction level, even for ETFs which have underlying, you know, or even for funds or fund managers who have underlying assets, but go to that underlying and then and there are methodologies where you can very clearly associate the underlying's ESG attainment with how the portfolio is constructed. Otherwise, we also have what's called portfolio greenwashing. It's not just greenwashing at an entity level, but entire portfolios are considered to be or labeled to be green when indeed they're not. It's just a matter of tilting or just a matter of structuring in a certain way. Things look quite different. And unless as investors, you are skeptical and you say, hold on, let me scratch the surface a bit and see what's happening under that, under the hood. And the markets are structured that way. People are incentivized to make themselves look far more green or sustainable than they actually are. So just bell the cat and say, I want evidence. I want data, evidence on methodologies and so on what you're measuring, how you're aggregating that to the fund level and the portfolio level and so on and so forth. But skepticism is, enlightened skepticism is very, very important.
Okay, Linus, I'm aware we're running out of time. So my question to you is, what is the next bubble in ESG investing? Please
what is the next?
Enlighten us.
Well, I mean, I think that there's a danger in terms of the term ESG in the sense that it's become so wide and all-encompassing, right? You know, food security is being banded in, healthcare, everything's being banded in. So obviously with such a large bandwagon of investments, you know, there's this sort of provide a lot of these solutions, and these are underlooked. So, you know, rather than talking about a bubble, I'll talk about what's, you know, overlooked in that sense. And these traditional companies do provide very strong credentials in terms of providing those urban solutions and solving many of our problems.
Kalpana, what do you think? What's the next bubble?
Potentially every trade, every industry could be a bubble, but I think it's good to think of ESG as a punctuation mark in financial markets. It is going to be a fundamental paradigm shift in how we think about business. For example, think of KYC in the past, 20, 30 years ago. There was no KYC. Today, you can't do business without it. Similarly, ESG, all trades will become ESG compliant. And so hopefully in that space, there will be fewer bubbles. But I know I'm out of time, but I just want to leave the audience with thought that beware, the next ESG bubble may come from carbon markets, which are very, very important. But there'll be a lot you'll hear about it in the race to net zero.